Are you ready to unlock generational wealth and secure a prosperous future for your family? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. In Canada, the Great Generational Wealth Transfer is well underway, with an estimated $1 trillion in personal wealth expected to pass from baby boomers to the next generation between 2023 and 2026. This monumental shift brings the concept of building generational wealth to the forefront, focusing on creating a long-term, sustainable portfolio that provides not just an inheritance, but a meaningful, life-changing foundation for your children. Jeff Lang, Senior Vice President of Business Development at Equiton, a private real estate investment firm, shares insights on how investors are increasingly looking beyond traditional equities and fixed income to maximize their portfolio's resilience. With recent market volatility and trade tensions, multifamily real estate has emerged as a stable and appealing asset class. Multifamily real estate, think rental apartments, are the definition of a generational long-term strategy, says Lang. If you're looking for monthly income, tax efficiency, potential for capital appreciation, and wealth preservation, there are many reasons we see investors turning to multifamily real estate. The nature of multifamily investing suggests that advisors should shift conversations away from short-term gains and toward long-term, tax-aware strategies. Lang notes that investors often aim for consistent monthly income in the 5.5% to 6% range while also deferring or minimizing taxes to maximize reinvestment potential. That reinvestment of gains is key. The effects of compounding can accelerate generational wealth goals, and having more to reinvest, paying fewer taxes along the way, can get you there even faster, Lang emphasizes. Lang also encourages exploring different account types and investment structures that support intergenerational goals. Options like in-trust for accounts or joint accounts with adult children can help minimize taxes as wealth is passed on. It's really important for giving your kids a head start if you have the finances, Lang says, comparing it to a child's registered education savings plan. The primary draws of private real estate for a long-term investment horizon are its historical stability and simplicity. Anything that doesn't have the volatility of the stock market is appreciated, especially in that later stage of an investor's journey, Lang explains. He points out that multifamily real estate's primary revenue source, rental income, is easy to grasp and particularly appealing as a passive investment, sparing investors the headaches of hands-on property management. For those focused on longevity and impact, selecting the right solution matters. Private equity real estate funds like the Equiton Residential Income Fund Trust invest in multifamily buildings across Canada and are designed with income, capital preservation, and long-term growth in mind. Lang underscores the importance of maintaining a diversified portfolio that includes equities, fixed income, and real estate, with each component playing a role in balancing opportunity and risk. It's important to look at the portfolio as a whole and consider the diversifiers, Lang advises. Having exposure to the equity markets, fixed income, and some allocation to real estate as a resilient cornerstone, I think that's a very well-rounded portfolio. Canyon Partners. Real estate has taken significant steps to enhance its bridge lending activity by refinancing a multifamily project located in Los Angeles. This move is part of Canyon Partners' broader strategy to capitalize on the growing demand for multifamily housing, particularly in urban centers where housing shortages are prevalent. The refinancing deal underscores the company's commitment to supporting the development and sustainability of multifamily projects, which are increasingly seen as crucial solutions to urban housing challenges. The Los Angeles project, which has successfully secured refinancing, is expected to benefit from the enhanced financial backing, allowing for further development and improvement of the property. This move is indicative of the broader trend within the real estate industry, where investors are looking to multifamily properties as stable and reliable investments. With the ongoing demand for rental housing in major cities, such projects are positioned to offer consistent returns and long-term growth potential. Canyon Partners. Real estate's decision to boost its bridge lending activity comes at a time when the multifamily sector is experiencing heightened interest from both domestic and international investors. The stability and resilience of multifamily investments, especially in dynamic markets like Los Angeles, make them an attractive option for those seeking to diversify their portfolios. By focusing on refinancing and supporting multifamily projects, Canyon Partners is aligning itself with market trends that prioritize sustainable and scalable housing solutions. As more investors recognize the value of multifamily properties, the sector is poised for continued growth. This is especially true in areas with robust economic activity and population growth, where housing demand often outpaces supply. The successful refinancing of the Los Angeles project by Canyon Partners Real Estate is a testament to the strength and potential of the multifamily market, highlighting the opportunities available for investors willing to engage in this sector. In Stamford, Connecticut, multifamily housing owners are proposing a new development that aims to enhance the local housing landscape. According to a report by Michael Giuliano, 3 owners, James Mafucci, Jared Schulman, and John Antonelli, have put forward plans for a 3-story, 19-unit apartment building. This proposed structure will be situated next to an existing property they own, further contributing to the area's residential offerings. The development, which covers 27,567 square feet over 3 parcels, is strategically located at 488 Glenbrook Road and 37 and 41 Parker Avenue. The proposal highlights a thoughtful approach to housing needs, featuring a mix of 1-bedroom and 2-bedroom units, with 3 units designated as below-market-rate housing. This initiative aligns with broader efforts to provide more affordable housing options in Stamford, a city known for its vibrant economic environment. The plan includes demolishing a 1-story, 4,000-square-foot structure formerly owned by Associated Water Industries to make way for this new development. This move is part of a broader trend in urban redevelopment, where older, less efficient buildings are replaced with modern multifamily dwellings that better meet the needs of today's residents. This proposal is scheduled to be reviewed by the city's zoning board, and if approved, it will add to the existing portfolio of the developers, who already own 2 adjacent 3-story buildings with 16 apartments and ground-floor retail space. This project not only signifies growth in Stamford's housing sector, but also reflects the increasing demand for multifamily living spaces, particularly in thriving urban areas. The commitment to include below-market rate units is particularly noteworthy, as it addresses the pressing need for affordable housing solutions in many urban centers. This reflects a broader understanding of the role that real estate development plays in fostering inclusive communities and supporting sustainable urban growth. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.